LPC's second quarterly market update of 2024. And for those who are new to our webinars, firstly, welcome. And how we'd like to proceed is by the LPC team of experts providing a high-level overview of the Q2 2024 status of the ANZ office, retail, and industrial markets. And then we'll be providing a commentary, but from a tenant's perspective. So today we've got the cream of the crop here at LPC. So we've got Julian Cura. He'll be discussing office. Adrian Gerber, he's a specialist in all things retail. And then Ken Lamb, and he's going to discuss the industrial sector. And then I will provide the statistical analysis around vacancy and occupancy in each commercial sector. Our agenda for today, we've got 3 snapshots. So we've got a snapshot of the office market, the retail market, and the industrial market. And then at the end, we'll have a Q&A. So please feel free to write your questions in the Q&A function as we go along. And just to note that the Q&A section is actually anonymous. So honestly, there's no stupid questions. There never was, but it's anonymous for those who care about that. Okay, so to kick off, I'll touch on some of the key recent articles from the AFR on the Australian, New Zealand office, retail, and industrial sectors. And then we'll be highlighting some of the trends that we're helping our clients navigate. So for office, workplace utilization has increased. So employees are returning to the office for multiple reasons, including a tightening jobs market in some industries, wanting to keep home and work separate, and then also just the fear of missing out. So as others return, everyone's fearing, what's everyone discussing within the office. And so it's acting as a catalyst for other workers wanting to return to the office as well. In Melbourne, like other markets, B-grade stock is not being looked at by tenants. And so this is, again, we've said this a few times in other market updates, but it's highlighting the continuing trend of a flight to quality. And Julian's going to touch on this further during his office section. Okay, so moving on to some retail articles. For retail, while retail sales rose by 0.6% in May, this was mainly, it's not really an upwards trend. So we think this is mainly due to end of financial year sales, and with many retailers still struggling. This is evidenced by the bottom article. As you can see, we've got an article about Carl's Jr. burger chain, and they've gone into administration. So even with a known brand, this retailer has found it difficult in this market. The retail market still favors the landlord, and this is evidenced by the middle article, which shows the power of the large landlords have over tenants. So we have a butcher, he's kicked out of his shop in Westfield, Bondi, without any explanation. And their shop was leased to a competitor, and they were forced to make good their expensive fit out that they had put in there. And so Adrian is going to touch on some protections retailers need to consider to mitigate these types of risks. And then just industrial. So finally, the industrial market continues to record low vacancy as a result of limited stock. And both vendors and purchasers are looking to capitalize, with many acquisitions of industrial portfolios taking place. It's showing the strong returns investors expect from the tightening market. And Ken's going to touch on this later. Okay, we're going to move on to the office market snapshot. So I will take us through the vacancy data. Then Julian is going to discuss the status of Q2 office nationally, market trends, and then provide some insight into strategies LPC has been advising our office clients to take in this market. Overall, Australian CBD office vacancy has remained fairly stable, increasing from 13.5% to 13.6% nationally as of July 2024. Non-CBD areas have recorded a slight reduction from 17.9% to 17.2% vacancy. CBD vacancy rates fell in Sydney, Brisbane, and Adelaide, with Brisbane recording its first vacancy under 10% in more than a decade. Vacancy in Melbourne continued to grow, recording 18% as of July 2024, with Perth and Canberra also recording increases. Flight to quality remains the main trend across the country, with 65,000 square meters of premium and A-grade stock taken up across the country, whilst net demand for B-grade space has fallen. Drivers such as work from home is allowing tenants to reduce occupancy and put the space savings into better quality premises. There is also the desire for buildings with tenant amenities such as end-of-trip wellness offerings, etc., to attract workers back into the office, along with increased expectations for sustainable buildings. If we look over in New Zealand, Auckland has seen a slight decrease in vacancy and Wellington an increase given new supply to the market. New Zealand is seeing the same flight to quality playing a big part in occupier decision-making, along with sustainability credentials becoming an increasingly important factor in tenant leasing decisions. Thanks, Julian. Over to you.
Thanks, Cara. So this slide illustrates the difference between the lease norms and market conditions. The LPC barometer illustrated on this slide will feature in each sector throughout this market update, with each presenter discussing at which point along the barometer the market and lease norms currently sit. In respect to the office sector, lease norms are still largely drafted in favour of landlords. However, there has been some shifts in favour of the tenant. The ongoing challenge for tenants is to continue to change these lease norms by incorporating tenant-friendly conditions, with a particular focus on transferring risks, obligations, and guarantees back onto the landlord. It's never an easy process, but much easier in a tenant-favourable market. If we look at the market conditions for the office sector, it is still very much in favour of tenants, as can be seen from the vacancy statistics presented by Cara. This is further compounded with a shallow depth of tenants in the market. That is, there are fewer tenants competing for the same space, and many tenants are still consolidating and reducing their footprint. This means that landlords are well aware that the vacancy levels will remain for some time to come and are therefore conditioned to be more flexible in negotiating tenant-favourable leases. If we look at the market status and trends, starting off with premium office buildings. As mentioned earlier, there continues to be a clear trend towards a flight to quality, whether it be a higher grade accommodation or better location. This has resulted in a two-tiered market with significant vacancy in secondary stock and a tightening in vacancy for premium stock in prime CBD locations. Secondly, vacancy continues in secondary grade assets. As tenants renew or reduce footprints or relocate to higher grade buildings, the vacancy in these grades continue to be challenging for landlords, particularly in non-CBD markets, with a national vacancy for non-CBD areas still over 17%. There are buildings in Sydney CBD and elsewhere around the country that have remained vacant for in excess of 24 months, with tenant demand simply not there. Thirdly, reuse of fit-outs, and this is becoming more relevant as time goes on. Whilst the cost of fit-outs has plateaued, the costs are still historically high, with a basic fit-out costing around $1,500 per square metre versus the pre-COVID cost of around $1,000 a square metre. The more expensive fit-outs, such as for top-tier law firms, are now in the order of $5,000 to $6,000 a square metre. Therefore, it makes sense for landlords to reuse and repurpose existing quality fit-outs and entice tenants by providing a market incentive on top of the existing fit-out. It also makes sense for landlords given access to cheap capital has dried up and the ability to offer tenants with capital contributions to fund a new fit-out may soon no longer be possible. The shortage of capital will also extend to base building upgrades such as bathrooms and lift lobbies, with works on these areas delayed by landlords as long as possible. An easy win here for tenants is to insist on no make good at lease end, given they potentially inheriting a fit out. Fourthly, tenant demand is limited. Tenant demand in sub 1,000 square metre market continues to be slower than historical. This can be contributed to small and mid-sized tenants being quicker to adjust to economic and geopolitical uncertainty. Fifth, landlords under increasing pressure, and this is throughout the press. Landlords are under increasing pressure from their investors with building valuations significantly down. A reduction of 20 to 25% off the peak values is common. Availability of cheap capital for capital improvements, including bathrooms and lobbies, is limited. This will make keeping the building relevant for tenants more difficult. However, it also creates opportunities for tenants that are able to fund their own fit out in return for other lease concessions. 6, flexibility in lease terms. Flexible lease terms continue to be negotiated for tenants that require greater flexibility to deal with future uncertainties whilst taking advantage of favourable leasing conditions over a longer lease term. Flexibility by way of early termination rights, contraction, and expansion rights. ESG, as featured in the last quarterly update, is still relevant also and will continue to be. As business reporting, ESG reporting for business becomes the new norm and an important credential in order to continue to do business with larger corporations. A trend for larger businesses has been to leverage a building and landlord that contribute towards achieving targets set by the business. This has become a significant consideration when selecting the right building and the right landlord partner. And finally, going early. After years of uncertainty in relation to the way we utilise our offices, in particular sharing arrangements on the back of working from home, tenants are starting to show signs of going earlier again, with many wanting to take advantage of favourable market conditions, ensuring that lease flexibility is a risk transferred to the landlord. It is without saying the importance of a sound leverage strategy in order to drive a favourable outcome is very much related to going early and not running out of time. In terms of the tenant perspective, in this table we present our strategies for our clients, including the associated outcomes. We will continue to use this table for different sectors and highlight the relevant strategies applicable to each, having regard to the current market conditions. For the office sector, our primary recommendation to clients is to focus on the strategies highlighted in orange, specifically portfolio optimization, review and reset. Often tenants sign a lease and don't look at it again until closer to the expiry date. The same can be said for portfolio of leases. Undertaking a review of a portfolio of leases against the current business requirements and market conditions often presents a number of opportunities that can be leveraged to reset and restructure a lease and portfolio. A good example is a legal firm that has traditionally been reactive to lease events. A recent review of their portfolio identified that many of their leases are not aligned with their business strategy and are generally unfavourable. The business has since reset their office leases in Sydney, Brisbane, and will do so shortly for Melbourne. And secondly, go big for substantial changes and risk transfer. It's always important to start with the business objectives and strategy to ensure that the lease and premises support the business. Often tenants will agree to unfavourable lease provisions because there is a preconception about what is typical or common market practice. The reality is that every clause in a lease is negotiable. If you have a sound leverage strategy, then don't be afraid to go big for substantial changes and risk transfers from the norm. Thanks, Cara.
Thanks, Julian. Some really good stuff there. Thanks, Julian. We're going to now move on to the retail snapshot. So again, we're going to talk about stats, and then Adrian will talk through the various sectors, or rather retail, and provide analysis from the tenant's perspective. So looking across our retail markets, vacancy has decreased in large format due to low levels of new retail stock. Our other retail markets have seen vacancy remain static. However, as highlighted in our news flash articles, there are disparities in vacancy, particularly in strip retail, where we're seeing some locations struggling with high vacancy, whereas other markets are quite tight. So despite a slump in retail spending with households tightening their belts, we're seeing some upward pressure on effective rents, with rents up and incentives down across most of the retail markets. Some small relief for retailers whose annual increases are tied to CPI is that we're seeing CPI figures ease from the 7 to 8% that we were seeing in some markets last year, down to 3 to 4%. So over to Adrian.
Thanks, Cara. So as Julian highlighted the barometers within the office market, the lease norms for retail remain unfriendly due to the supply side power and market coverage that landlords hold as a collective over retail tenants, as well as the restrictions within the state-based retail leasing acts. With the market conditions, as Cara mentioned, they're quite varied over the different types of retail. In theory, they should favour the tenant. However, landlords are not taking into consideration the needs of tenants in light of the current economic conditions. As an example, with the retail market experiencing difficulty due to inflation and interest rates, landlords should be motivated to look at ways they can reduce outgoings and operating costs and subsequently pass these savings on to their tenants. In a recent example, a large institutional landlord has tried to renegotiate a net rent to a gross amount so that substantial outgoing saving will not be passed on to the tenant and instead artificially inflate the rent. Unfortunately, due to the fragmentation of retailers, the shopping centre landlords especially are unwilling to negotiate, and the tenants therefore placed in a difficult position to either accept their terms or potentially have to vacate and lose their business. Next slide, please. So with large format retail, the economy is continuing to have an effect on this sector, with the electronics, footwear and furniture sectors especially showing negative inflation. Whilst population growth and tax cuts that have recently come into effect will assist, the rate of growth is still slow. The lack of new properties and space in large format retail is forcing rents to increase, with limited opportunities for new and relocation sites. However, for some tenants, the rent increases along with the hike in construction costs is making new sites difficult to justify. And we are now seeing some opportunities present themselves whereby existing tenants cannot afford to keep their doors open. Landlords are continuing to resist incentives on new sites, and incentives on renewal are almost non-existent given the increased cost of borrowing money. Time and skill is required to achieve results in this area. Currently, our large format clients are looking at existing sites from a portfolio perspective with careful consideration and decision-making based on informed data to either remain in situ or relocate to a superior location, especially given fit-out costs, the reduced amount of CapEx available, and the need to maximise store sales productivity given the lack of new floor space available. Next slide. So with shopping centres, the rate of inflation is again influencing how customers shop, with a reduction of spend on non-essential products, research product pricing, and an increased awareness of sales, cheaper products, brands and stores. Shoppers are also more purposeful with their shopping, so having the right experience, products and staff are more important than ever to ensure healthy sales conversions. Retail trade figures in June saw a 2.9% growth compared to June 2023. Other retailing, including cosmetics, sports and recreational goods, plus food, saw the strongest growth of 6.3%. Department store growth grew by 4.2% and food by 3.1%. Household goods and cafes, restaurants and takeaway food had the least growth of 1.1%, indicating the cost of living crunch. Shopping centre landlords are still seeking rent increases on renewal by 10 to 20%, along with longer lease terms and fit-out upgrades required. Many tenants in larger shopping centres continue to be affected by relocations on renewals as the landlords revisit tenancy mixes and seek international tenants to maximise turnover and rental growth. This was one of the examples that Cara provided in her slide originally. As we discussed with large format retail, landlords are only providing incentives on new sites, and even then the amounts are reduced or reflected within a higher face rental. With the CBD, retail rents have remained stable over the past quarter due to the effect of interest rates and reduced discretionary spending. However, the CBD will more likely never return to pre-COVID levels due to the change in office working habits. In the suburban market, the market is two-paced. In the busy prime suburban strips like Chapel Street, South Yarra, or Boundary Street, West End, vacancies are rare, rents are increasing, and new opportunities are mainly sourced off-market. However, in the secondary locations, there are many options. However, landlords are hesitant to provide generous incentives, given most are smaller investors. We're also noticing that tenants are much more considered in their decision-making. Prior to COVID, retail tenants may have taken a site even if it wasn't in their preferred location, as they're backing their brand and economic conditions to make the site work. Now, tenants are prepared to wait for sites that tick all their boxes, to ensure that the business has had the best opportunity to be successful. And this has an impact on the secondary locations. Tenants are just not prepared to take a site in a secondary location and wait for the prime sites to come available. Landlords need to continue to be reasonable, implement rents reflective of market, and recognise the current pressure on retailers. This month, we've seen a landlord requesting a 3.5% increase on the rent at market in a location where rents have significantly reduced over the past 6 months. Beware of landlords who provide standard increases, say the 3.5% or 5% increase, with no justification on the rent increase. Many of these situations reflect overinflated rents. So there are a number of strategies that a tenant can enact to receive favourable outcomes within the retail sector. I've highlighted 2 in orange on this slide. The first one is lease restructure before expiry. Time is your leverage, go early. In the situation I just explained previously, don't leave your negotiation on the market review to the last minute and within the requirements of the lease. Engage with your landlord 1 to 2 years prior to the lease expiry to utilise your leverage of time. Also, speak with other tenants in your shopping strip or centre to find out how their business is doing, what they are paying or incentives received. Look at alternatives and do it early, so if you have an option, it is your backup plan. Negotiating early or before your option is due to be exercised allows you to renegotiate your lease and look for opportunities to transfer risk, such as removing personal guarantees or additional option terms. Thank you.
Thanks, Adrian. Finally, we're going to move on to the industrial market. Quick review of the stats and then the current status and trends for industrial. Okay, looking to our latest industrial market. We can see a sea of green on this chart, and we haven't seen that for a while. So after long periods of record lows, we're starting to see vacancy increase across nearly all markets, with Wellington the only outlier this quarter, shifting down from 1.8% to 1.1%. So whilst vacancy is still fairly low, as we see in Sydney, it's still only 0.5%. This data shows some relief for industrial tenants is on the way. So while vacancy is trending upwards, we will start to see rental growth plateau and effective rents come down as incentives increase. Over to Ken.
Thanks, thanks, Cara. One of the key differences this quarter is that e-commerce penetration is stabilising as a result of the cost of living pressures. For industrial occupiers, this is a glimmer of hope. As we have previously reported, e-commerce has been the primary consumer of warehouse space, which has led to current low vacancy rates and upward pressure on rents. There is still low levels of supply, and around half of the new stock coming onto the market over the next 12 to 18 months is pre-committed, but the new stock and reduced demand will certainly relieve pressure in rentals. As Cara pointed out and alluded to, vacancy rates across all major capitals in Australia and New Zealand have increased. However, Australia still has some of the lowest vacancies in the world, and in the absence of any major injection of uncommitted stock coming to the market, we anticipate these vacancy levels will remain low for the foreseeable future. Landlords will still be keen to maintain upward pressure on face rents, and with the dampening of demand, we are seeing the return of incentives. Incentives range between 10 to 15% are now being negotiated. In some cases, where there has been no movement on stock, we have negotiated incentives as high as 20%, which is great news compared to 12 months ago when incentives were not being offered in any markets. What are the market trends? The industrial market remains resistant to economic tailwinds and global uncertainty. However, as the vacancy rates indicate there is a softening of the market, major agencies are reporting that inquiry levels are back to pre-COVID levels, and it's often the case that tenants are remaining and renewing the lease in potentially a suboptimal premises, simply just to ensure that they have a home for the next 3 to 5 years. There is now evidence that rentals are increasing at a lower rate of growth, and it's anticipated that growth will plateau. Of course, our landlords, in particular the institutional landlords, will want to maintain healthy face rents to maintain the balance sheet credibility, so we anticipate incentives will still increase over the next 12 to 18 months whilst face rents are being held. We've also mentioned a few other trends that are emerging in the market, in particularly multi-story warehousing before, but now there is actual product being delivered in the market. At this stage, it's only 1 to 2 levels, or even up to 3, and it's located in the inner city suburbs and the metro markets where there's a lack of supply in stock, in particular in the South Sydney market and the Southwest market. Finally, with other sectors, ESG issues are becoming more increasingly relevant and in demand by occupiers. Not only can it contribute to a reduction in carbon emission, it can also potentially lead to cost savings. For example, rooftop solar panels are being rolled out by industrial developers in response to occupier demand as the means of reducing energy costs through selling excess energy into the grid and passing it onto the occupiers to offset increased energy costs. So where do the opportunities lie? The industrial market has been a landlord's market for the past decade, experiencing year-on-year rental growth, decreasing vacancy, and dwindling incentives. And whilst the market is adjusting to lower demand and some better levels of supply, there is still little leverage for tenants in both terms of the market conditions and lease conditions. And the sustained growth of the market has skewed the norm towards a landlord. In order to shift the needle on the barometer and bring it back to the favour of the tenant, careful consideration of business needs, expert knowledge of the market, experience, and patience are essential. On the next slide, we'll look at some of the potential strategies that can assist in moving the needle on the barometer to a more balanced, tenant-friendlier situation. So despite some good news this quarter, the industrial market remains tough for tenants, which certainly limits the leverage available. Nevertheless, there are a number of strategies that we have used to improve industrial tenants' position. Our negotiation strategies turn on the 5 key categories: costs, risk, flexibility, obligations, and guarantees. Whilst there has always been intention given to cost in a market such as the current industrial market, driving down costs is not impossible, but is a difficult proposition, and it's arguably the better outcomes may be achieved by a focus on other factors such as risk and obligations. A strategy we often apply, particularly for multi-site occupiers, is a portfolio review in which we take a strategic view to identify opportunities to better align a client's property portfolio within its business needs in order to optimize its property performance. A typical example of this is a trend for a number of Sydney occupiers who are looking to relocate and consolidate their footprints to another city or further afield in order to take advantage of more favourable rents. Another strategy is to look at mitigating risk and transferring certain obligations to the landlord via side deeds or through a variation of an existing lease. Everything is negotiable, but make no mistake, it's hard yards and it takes skills and patience. And a good example of this in the industrial sector is a commitment or obligation on the landlord to meet certain energy targets through initiatives such as solar power. Increasingly, we are negotiating provisions in the lease of this nature.
Okay, great. Look, I think we've run out of time. What does everyone else think? Should we do one question? One question? Okay, cool. All right, I think this looks like an office sector one, but any of you can answer. So if landlords are delaying upgrades, etc., how does a tenant protect themselves against not getting what a landlord represented would happen? So how are you going to protect yourself?
Yeah, do you want me to answer that?
Go
Look, it's a
Julian.
really good question, and it's something that is featuring in the negotiations that we have with clients, especially when we go through a building and they present all the amenity, etc. What we're very careful of is recording what it is that they're offering, and then incorporating that into the heads of agreement. And it's interesting how all of a sudden the discussion can change. But that's what we do. We try and make sure that it's reflected in the heads of agreement and the lease throughout the term, and that level of amenity or the upgrades of the bathrooms, they're pre-populated and the tenant knows what's going to happen.
Yeah, got it. So specific timeframes, specific actions, and then no reasonable endeavours.
Correct.
Pretty much.
Absolutely. Reasonable endeavors. That's right.
No reasonable endeavors. All right. Well, thanks everyone. That was really great. The content was really great. So don't forget our next update, Q3 2024. Put it in your calendars. Sign up now. 7th of November 2024, 10 to 10:30, same time. Thanks everyone.
Thank you.
Thank you.